What's going on, YouTube fam? This is the Wealth Investing Network. We do this for the win. Today we're talking about a tech stock that's down 90%. This article claims that you'd regret not buying on the dip. We're going to discuss that today. And not only that, we're going to throw in another stock that's their competitor that I find those businesses to be very similar, and those stock performances might do some interesting things compared to each other. So we've got Fiverr and Upwork. Those are the two stocks that we're talking about today. So look, down 90%. Even this article says that's an abysmal performance by any metric, pretty much. However, it's down a lot from what was happening at the end of 2020 and the beginning of 2021. That period had a huge rise up for Fiverr because this company is helping to power the gig economy. Hiring freelancers is relatively quick and cheap compared to hiring full-time employees, and some people are just looking for some quick work. They're not looking for necessarily the benefits that are coming along with it. We're talking about areas like graphic design, video and animation. In theory, I could be hiring someone on Fiverr or Upwork to help me with the kinds of videos that I make, but I do this myself. And so that accounts for the quality that you're getting, for better or worse, I guess. But obviously during a period where everyone's at home, a lot of stuff has to be done remote. In terms of gig work, this was a prime time to get in on this type of action. And you would think from this stock chart that a company like Fiverr and maybe Upwork as well stopped growing and actually started declining in terms of their business, in terms of their revenue. That's actually not what happened in the course of 2022 on through 2024. Stagnated, but we haven't seen the kind of decline that might be suggested from this stock price. I think the stock price indicated that, oh, this is the new world, that it's going to be like this forever. And as some of the panic subsided in late 2022, we figured out, oh, maybe Fiverr and Upwork aren't going to be as essential as previously thought. So this company actually first went public in 2019, and the business soared in 2020 and 2021. But things have slowed down considerably. And 2019 was actually the perfect time for this company to get on the market. The perfect time for people to get excited about a company that wasn't profitable at all. But guess what? Now they're profitable. The company used the period of 2020 and 2021 to grow. So they were seeing huge revenue growth year over year, quarter over quarter. But they were bringing in losses. They were spending more than they were actually making. And then the company actually aggressively cut expenses and costs. They figured, okay, we're not going to grow at this rate forever, so let's actually get profitable. And I think I'd agree with this article that that's a great sign for investors. These charts for their sales and marketing expenses and their total expenses actually tracks it pretty well. They went from spending about less than $20 million in marketing to over $40 million in marketing. And then they kind of cut that off, or at least let it plateau. Their expenses overall plateaued as well. And so this article basically argues that they have a long runway for growth, right? Especially now that they're profitable. They don't have to consider taking on a lot more debt in order to fund their operations. They can actually just work as is. They can capitalize on things like artificial intelligence and AI, and the demand for their AI services is actually growing faster than the rest of the business, according to the CEO, Micah Kaufman. And basically, I kind of see this business as a more direct version of LinkedIn in terms of pairing companies looking for someone to hire with actual employees or gig workers ready to work. And Fiverr actually being able to take a cut of that. Now at the heights, this company had a market cap of over $11 billion at their height. Now, in the past year or so, they've vacillated between 1.3 billion, 800 million, in that range. And they're doing that off of a trailing 12-month revenue of about 366 million. Skipping back up, that's interesting to me. Price to sales ratio around 2. That's typical for tech companies, but a company that's not growing as fast is going to command a lower and lower price to sales ratio. So unless they can kick that revenue growth back up, this price to sales could even be high. I do like that we're finally seeing a small profit, and in theory, this profit margin could continue to go up if management does what they're supposed to do, basically. But again, quarterly revenue growth of 6% doesn't impress me. I mean, I would want more than a 6% return if I'm going to invest in a company. You could get close to 6% at the bond market at certain times. But I do like that they have about as much cash as their total debt. So that's kind of a wash. And as the company becomes profitable, they'll be able to pay off this debt more. Maybe with the cash, they'd be able to make acquisitions or start doing things like buybacks, dividends, things that investors want to see. One interesting thing, that the short percentage of their float, or the short percent of their shares outstanding, is kind of high. So you could see a spike happen if these shorts have to sell out on good news or something like that. Now, Upwork, the reason why I haven't talked about them as much specifically is because these companies are so similar, very similar market cap, very similar price to sales. Upwork has a little bit higher of a profit margin, probably maybe even a bigger factor is that their revenue is about double. So a bigger company in terms of their revenue, similar in terms of their market cap. So that could be something interesting to look at. Again, cash and debt is somewhat of a wash, and then their short percent of their float and their shares outstanding is almost the same. So these are so similar. It's hard to even talk about them very differently. I think another interesting thing in terms of Fiverr is that their market cap went up to over $11 billion. Upwork saw them go a little bit above $7 billion. So when it comes to the market being excited about a company, I think for some reason there's more excitement when Fiverr is doing well versus when Upwork is doing well. Again, something interesting to look at. Now, these are both stocks that I've put on my watch list. The reason why I put them on my watch list is because I don't think they're ready quite yet. We're looking here at the 200-day moving average. There's been a couple times where it's broken above this 200-day moving average, but they continue to have lower highs. So I'm waiting for the stock price to break above the 200-day moving average on this chart, but break away in a clear way, not just a spike. And keep taking a look at earnings, right? So if their earnings report is telling you something, definitely look into that. I haven't seen anything that I think so far is going to make it rise up. Similar chart for Upwork, not exactly the same. We did see it really break above the 200-day moving average, but now it's right back below it. So I wouldn't really be too interested if it comes up and touches it. It's really about breaking above that 200-day moving average. Let me know in the comments what you think about these two companies. Let me know what else you want to see on the channel. I'm trying to get back into making more videos. Usually at the end of the video, I share some sort of secret with you. So today, the secret is I am just really frustrated with these frogs around my house. I'm trying to find a way to get rid of them. I have these frogs that sound like dogs. It's ridiculous. I've tried spraying vinegar. I've tried putting coffee grounds around the house. Next, I'm going to try some strong smelling plants and flowers. Please let me know also if you have any suggestions about keeping frogs away from your house. Hope you enjoyed the video. Please like, subscribe, all those things. Hit the buttons. I'm out.